We're live. We actually just had a smart-ass comment come in from a lawyer friend of mine who's actually been a guest on this podcast and put out quite a sterling display, actually, 2 hours after he was supposed to be live. So I found that tongue-in-cheek comment quite ironic, but that's okay. We'll roll with that. Thank you very much. You know who you are. I think you're watching. So we've just invested in some new podcasting equipment. I hope those of you out there, I see there's a few of you on there watching, can hear me better than you would before. And we're working on the backdrop. It's at this stage not overly aesthetically pleasing. We've got a few little trinkets and sports cards in the background. I've got my best togs on for today and trying to illuminate you guys with some insight or at least information regarding the changes that have just been announced by the government regarding property investment. So we'll just get straight into it. The Brightline test has been extended from 5 to 10 years. Now, my juniors and I, the best we could find was that will apply from all property purchased from the 27th of March, which is this Saturday. We couldn't find out whether that test will be extended in the short time we've had to look into it amongst trying to actually make some money. Can't figure out whether that applied to, say, a property bought in 2016, whether that Brightline would be extended for that property. So we'll have to watch the space on that one. We can put it in the comments when we've had more time to look into that. But I think it has just been extended to 10 years for property purchased on or after 27 March 2021. If anyone out there's watching and knows the answer to that, please post in the comments or message me. That'd be great. The test for new build investment properties will remain at 5 years. So if you purchase a new build, that Brightline won't affect you. Oh, sorry, for those of you taking a real basic approach, for those of you who don't know what the Brightline test is, it is a test that means that based on your income, so say, for example, you earn over $70,000 a year, if you resell within a 10-year period, that gain, that profit you make on that property, the difference between the purchase price and the sale price, will be taxed at your personal income rate. So say, for example, you earn over $100,000 a year. Say you earn $100,000 a year. Well, then and you sell a property and you have a $200,000 profit, you'll be taxed at 33 cents on the dollar for the first 80,000 in that example. And then because the personal tax rate up to 180,000, from 70,000 up to 180,000 is 33 cents on the dollar. And then at 39 cents on the dollar from 80,000 up to the rest of it, the 200,000. So as you'd see, it's a fairly considerable tax effect, and a lot more than was mooted in the 2011-2014 capital gains tax policies that were put out by government, or mooted by government at that time. So it's a considerable whack. However, I've got reservations, and talking to a couple of investor friends of mine have reservations as well. Actually, I've just had a caller come in, actually. I'm just going to, with my new technology, I'm going to answer it, and I'm going to link him in. Shafraz, you should be live on air. Are you there, Shafraz? You can hear me? Shafraz?
Yeah, I can hear you. Can you hear me?
Yes, you are. You are live. Welcome.
Oh, hello, Shane. How are you?
Extremely well, Shafraz.
Oh, mate, it is very good that you've done this so quickly. You must be one of the very few people who've come to grasp with this extraordinary piece of announcement so quickly.
Oh, thank you for calling in. Have you got any insightful tidbits you could offer us?
Well, it would be good if you actually start streaming on Facebook, because there must be a lot of people still waiting and it's not working.
Is it not working?
No.
It says we've got 4 viewers of our stream.
I've been knocking and it's not going on.
I'm going to get our technical producer, Luella Martin, in the background here to check that. Oh, it is working. She's just held it up to me.
Mm.
Perhaps you're having some technical problems at your own end.
Oh, here we go. You're on. I'm one of the three.
You're one of 4 now. Welcome. So have you got anything? What do you think? I mean, I've talked to a couple of my clients this morning, and they've said, well, we don't plan on selling any of our property within that 10-year time frame, so they don't think it will have any effect.
Well, I think that the tax amount of these people,
the tax announcement in terms of the deductibility being phased out gradually over the next 4 years?
Yes, I mean, if these people are able to bear that cost, then it may not affect them. But look, I think the problem is today, people are now going to be holding on to property for 10 years. Then that will stock. And if there's no availability of, or fewer availability of stock, and the government is now putting a few $1 billion into state house building, and we have very limited builders, who's going to be building new houses, and where is the new stock going to come from for people looking for houses?
I think they have put some initiative, reading the fine print from the interest.co.z article this morning, I think they have put some more funding into build.
Also funding are going to be building for the state, and that will take stock away from the private market. Building infrastructure. I think we should have done the structure. I personally don't think we should have taken these drastic steps in the first place.
Why do you stick?
There is a lot of mum and dad investors out there. I mean, the way the government has painted this whole policy, they but 90% of the investors out there are not speculating. There may be 10% of investors who are speculating, but 90% of investors out there, maybe more recently increased, a lot of money and dad investors out and bought a rental property to supplement and use equity.
That's true.
I think everything that's come through is to reduce inflation, but there's only about 10 of the investment, the greater market.
Could you make an argument there is a better use of bank finance for business rather than to the property market?
Well, I mean, where demand is going to be created for it, in the country there has been demand for housing. And the market has been created. And look, if the mum and dad investors are going to be get out because now they can't be funding the shortfall, then I mean somebody else is going to get into that market.
So you think it might actually have the ironic effect of robbing the people who actually viably are going in there just for a retirement plan, so to speak, from the opportunity to have access to that capital to invest safely, which wasn't the intended effect?
Oh, look, definitely. I mean, they're going to argue those are not going to be affected because they're not going to get rid of their properties within 10 years. But on the flip side, now they will have the added cost of the interest that they have to bear themselves. The only way I think that is going to sort of come off is if the rents are increased. I mean, look, most of the mum and dad investors out there, they're really barely making the expenses off the investment.
Yes, that's true. That's true.
And now, with them not being able to offset interest, either it's going to be coming out of their own pockets, which means that they're not going to be spending that money in the economy somewhere else, in our sort of hospitality or somewhere else, or they're going to be increasing their rent. So, the money's going to come out of the economy. It's not going to be coming out of somebody else's pocket. And it's going to affect other sectors.
And at low interest rates at the moment, one could dismiss the effect of the lack of interest deductibility as almost window dressing. But if that goes back to a more historically average rates of 5, 6, 7%, that could be have a massively significant impact, couldn't it?
Yeah, and we have to remember that within the last 3 years, this is the second change. The first change was basically what was traditionally known as negative gearing. That sort of was phased out.
Yep.
And you could not do that anymore. But now it's sort of the second step. Now you can't even deduct interest as an expense. So this has been a quick succession of two changes. So even though the interest rates are low and traditionally they're a few percentage points higher, the two changes combined has got a double effect on investors.
I still think, though, there's a reasonably cogent argument that so many boomers were affected by the 87 crash, and they still don't want to put their toe in water in the share market, and our share market as a result hasn't grown historically, whereas in the States, people are quite happy to put their money into shares because of what happened in 07. And you're starting to obviously see all these alternative asset classes grow in popularity because of that. But are we looking at it through a funnel, and are we looking at it in the way that to say, well, how could they do this? This is the only viable form of investment outside of work. And I don't know if it is. I don't know if property is all it's cracked up to be in terms of actual returns. And I'm not a financial guy, so I'm not going to try and form a balanced or a principled argument around that. But I still think we sometimes look at these things with tunnel vision without a broadness of the macroeconomic position. I know Shamil Ekwab and some of the much brighter minds than myself have some pretty interesting views on exactly what productive investment is, and property isn't one of them. So, we could sit here and talk about it till the cows come home, but I get your point about the fact that, just to sum that up, Shafraz, 90% of these people are, as you say, just very typical mum and dad type investors who want a safe bricks and mortar investment. They don't have to deal with the contingencies around other human beings and startups and all of that type of what they see as tricky stuff. And they just want to put their money somewhere where they can get at least a reasonable and safe return, particularly with interest rates at historical lows. Do you agree with that?
Oh, I totally agree with that. In terms of the share market, if you really think about it, if you've got a $200,000 equity in your home, it is a lot safer bet, and you would feel a lot safer with dollars and buy an investment property, then withdraw that $200,000 and put it on the share market. We don't have, typically we don't really have that much education around the share market in this country for people to invest in shares and do those things, not safely but confidently. I personally would not go into the share market and try and invest in the share market because I don't know enough about it. Overseas, like United States and all these places, you see, there is a greater education on the share market, but if we're talking about the share market, there's nowhere more speculative than the share market itself. And if you want to take speculation out of the property market and put it somewhere else, that's really robbing Peter to pay Paul, isn't it?
Yeah. Right, Shafraz, well, thank you for calling in. I'm glad the software works. I assume it works. Otherwise, people have just been listening to me and then gaps for the last 10 minutes. But it's been you've filled in some gaps for us. It's been great having you on, and I look forward to seeing you at indoor cricket on Thursday. I just hope I'm not batting with you.
I'm glad that I'm your first caller. You were very good start.
Our first ever caller, which is a great honour for me. Thank you very much.
All right. Thank you.
Thanks, mate. Cheers. Bye. Shafraz Khan, Fortune Manning, traffic law expert, smart ass, someone with strong opinions about everything, including the property market. Thank you very much, ladies and gentlemen, for tuning in this afternoon. Sorry about these slight technical pauses. We're just acquainting ourselves with the new technology, and we look forward to seeing you on again here shortly. Thank you.